Hi, I'm Dominic Picarda here for InvestorsChronicle.co.uk with an update on the outlook for US stocks. Now, it has been one hell of a run on Wall Street since the lows of December, and indeed the lows are back here in October. And as of now, the S&P is knocking on the door of its 2011 highs around 1370. The Dow is right up around its 2011 highs as well. In the case of the S&P, this index is now looking really quite overbought. The daily RSI reading yesterday was about 74%, 75%. Now this is a high. This represents a fairly overstretched market, and for me, the case for some sort of correction is stacking up pretty nicely right now. And I want to take a look also at the timing factors. Specifically, there's a cycle which suggests also a correction in the S&P and also for the Dow is due in the current time frame. So here obviously we've got the price of the S&P, and this red line here, this is the 38-day cycle. And if we look at the history of the last year or so, you can see that this cycle has done for me a really quite good job in capturing the most of the major turning points that we've had during that time. So we got the October highs, we got the October lows. It identified the turning point here. The last signal from this cycle, however, was here in the mid-January, and it was a dud. I mean, we had a hint of some sideways action, the mildest of corrections here. The cycle, for me, would have been implying a high. We didn't really get that. And this is what happens during really strong liquidity-driven rallies in the market, such as we're basically seeing now. Will we now get a second dud signal in a row? Because the 38-day cycle is due to top out around the 10th of February, or the next market day, which is the 13th of February. And certainly would fit because we've got the market at its highs, we've got the market looking really overbought. Sentiment readings are very bullish indeed. That is, of course, something which makes it also ripe for a correction. However, I don't know whether we'd see a really big pullback or really significant one at all, because in these liquidity-driven phases, you can get something really quite mild, maybe just a pullback to even around the 21-day exponential moving average would be my definition of a really quite a mild correction. And one way or the other, I reckon that the next correction, the next pullback in the S&P and also for the Dow is going to represent another buying opportunity. Clearly now we are I think both the S&P and the Dow are in a bull market. The S&P has re-entered a bull market, having suffered a formal bear market of 20%, and I think the Dow never actually left its bull market in the first place. So, also last week we got a golden cross in the S&P 500. That was when the 50-day moving average moved above the 200-day moving average. So, and this indicator gets thrown around quite a lot, but it's actually quite a good one because over time, the median gain following a golden cross in the S&P has been around 18%, and its consistency rate has been pretty high. About 2/3 of the time after a golden cross, the S&P rallies by at least 10%. So all of this leaves upside potential for me. Obviously, I'm not a long-term bear of conviction, a bull of any great conviction. I think this whole thing is just being pumped up on free money. However, when you're trading, it helps to not to think too closely about the logic of what you're actually doing and merely to follow the trend. I don't like to look at the fundamentals too much. I find them pretty worrying, to be quite honest. But we are not near a major top as far as I'm concerned. Nothing to me says that we're near one. And so if I'm right and we do get some sort of pullback beginning in this time frame, which we're essentially already in, then for me it's going to be another opportunity to establish a decent long position in the S&P.